you start to see these forks in the road of, my guests all the time. And I often say, what was a fork in the road for you? And I don't want to put words in your mouth, but, there was a couple there that I picked up on, not the least of which is one of the forks of the road for you was at 16 years old when you realized what the stock market could do. Then when you're a little bit older and you go on vacation and you go, oh no, it really does work. And you made a bunch of money. And I can't, I don't want to overstep the fact that we talk about $2,000 today or $8,000 today, and it's really doesn't have the impact. But back when you were doing that, $2,000 was a big amount of money. That was a pretty risky amount of money to throw in the stock market at that point. $2,000 was a lot of dough, and to make $8,000 was a pretty big upside given the buying power of our dollars back then compared to where they are today. But something that stuck out for me, Chris, is that, and I see this often with entrepreneurs, is that you and your friend, when you said, okay, I want to, I kind of got a handle on this whole investing thing. You believed you did it to the degree, got it. But then you said, I want to do this newsletter. I want to share what I've learned with others and show them that they can do it too. And yes, I can build a business model out of it, or I can make a little bit of money on my newsletter, whatever your story was around that. But what I keep hearing with you, and maybe you could expand on it a little bit, is you recognize the fact that you like to be a contribution to support others' success. Is that a real conscious thing, or are you more aware of that now than you were back then, or has it always been that way for you? Give me a little bit of background in that, because it's, as much as you were there wanting to be profitable, and I get all that because it's business, it was driven by more than just let's go out and make money. And I don't want to put words in your mouth, but can you expand on that? Am I on the right path in terms of your thought process?
Yeah, I mean, I'm for sure. So when I was younger, when I was my 20s, killing it with the newsletter, making money I'd never thought I'd be making. I was more or less, I was all about the money. How can you not be drooling about it as a 20-year-old making lots of money? But I've always tried to help. I love to kind of teach, explain stuff. I'm big into personalities. So I don't know if you're into the Myers-Briggs, the personality test.
Yep.
So like I'm an INTJ, which is considered like the scientist. I'm logical. Everything makes sense. I'm a little bone dry. I might not be the most, I can't connect emotionally with everybody, but I understand when I want to know something, I dig deep and I learn everything about it. I feel like I'm a pro after a few months because I've literally watched and read everything there is about it. And I like to explain, I like to show people how things work. And so I think that's always just been part of me. Every time I do something, it's always like, I want somebody to be part of it. Come on over, let's do this together. Check this out. I want to experience it with others. Like, it's just a lot of fun. And watching the pain and living through the pain of watching somebody lose their life savings and having to start over. I mean, it's a very difficult time. You lose friends, you lose family. It's embarrassing. I mean, you just name it. It's pretty shocking. And the last thing I want to do is have that happen to me. I don't want it to happen to anyone else. And, now it's all about, I'm at a point financially where all I really want to do is just help as many people as possible. And I'm on the same boat as they are. I want to protect my capital. I'm going to do everything I can to protect it and share everything that I'm doing and how other people could do the same thing. But it's just part of who I am. I'm a really nice guy. And I mean, I'm always here to help. And the nice guy, I found the nice guy usually gets screwed quite a bit. I've had some interesting confrontations, but that's what makes you who you are. And that's what sets you apart. And it just makes you a better person in the long run. But
it's funny. It's funny you say that. Most people don't know it, but I'm a really nice guy. No, I shouldn't say most people don't. and because I come across as sometimes pretty forthright. But the point is, sometimes there is that story where I go, yeah, I think it's true. Nice guys finish last, because that's sometimes how I feel in terms of getting beat up and going, how the hell did this happen? I was just being a nice guy. But there's a couple of things I want to pick up on there. And I would like to talk a little bit, Chris, is that, here we are post-pandemic. The world is the way the world is. When you look at what you've learned and, when you talk about with your, the people that you're educating and or supporting with your newsletter, et cetera, and guiding them and or giving them information. And what's your philosophy when you look at investing? How do you cover your assets, if you will? How do you, in fact, play defense while playing offense? That feels a little bit like one foot on the brake and one foot on the gas. I know it's not that, but when you philosophically are explaining it to your community, How do you position it so that people are understanding the difference between being defensive and offensive, and what's your guidance around that, given how the world's changed?
Yeah. So without trying to get too technical, the bottom line is I look at the stock market. So everybody's got their own style of trading, and there's certain assets everybody loves. Some people love precious metals, others like penny stocks, others like bonds or whatever it is. I've found that there's certain assets that I want to be involved in that have a lot of potential. And to me, that is the US stock market. To me, the US stock market has got the most liquidity. It's got lots of volatility, which means it's got lots of potential. It moves a lot, so we can make a lot when it has a nice move. And so that's the top asset. So I look at the market through a lens of like a hierarchy. Which assets are at the top, the most powerful? And as you go down the hierarchy, which ones have less volatility? They move slower, they're safer. Eventually, we get down to a cash position, which is pretty much as safe as you can go.
Mm-hmm.
So the way I trade or invest is simply I follow price trends, and we're looking at the hierarchy. And if the stock market is on an uptrend and gives us a buy signal, it doesn't matter if we're in any position lower in the hierarchy. We close that position and we move to stocks. We want to get in the leading horse, the one that's moving the fastest with a clean trend in play. If the stock market falls out of favor, then we sell that position and we potentially move to an asset that is lower on the hierarchy, that is moving slower. Because typically, if the stock market's falling, volatility's up, there's a lot of fast movement. So we want to move to an asset that's moving much slower to counter the extra volatility in the market, right? The fear and greed waves. So we could move to bonds. If bonds aren't favorable, then we'll rotate to the dollar index, which moves very slow. Big day in the dollar is, 0.5%, 0.75% move. And then if nothing there is favorable for the dollar, we'll just sit in cash and collect interest. So as the market gets crazier and crazier, we're just moving down to safer and slower investments. And the nice thing about each one in the hierarchy is they're not correlated to each other. So the stock market could be falling, bonds could be going up, or stocks and bonds could be falling like in 2022, and the US dollar is screaming to the upside, which was the best asset to be in 2022. That was the play to be, super conservative, and it just screamed higher. So all we do is we take one position. We're in whatever asset is trending up that has strong technicals. And if nothing has strong technicals, we just wait in cash. And believe it or not, we sit in cash about 40% of the year, meaning our money is never at risk. We're collecting a little bit of interest. And then when something is really strong and a good play, we move into it, we make a killing, and we wait for that trend to end. And then we just rotate to the next asset. So we're not holding a basket of things and riding the everyday volatility. We're literally sitting back like a sniper and saying, okay, US equities are a buy. Let's get in. The NASDAQ's the strongest. Let's get in and ride it up. And that's what we do. And as soon as the technicals break down, we start peeling off profits, making our positions smaller. And eventually we have none left and we wait for a fresh new signal. So we literally only hold assets going up. That is our whole focus.
Yeah, so you're not playing the downside. You're not selling anything short.
We don't short, but when we do get into we didn't really cover it, but a stage 4, which is a financial reset, like in the 2008 and 2000 tech bubble, when we get into a stage 4, we actually play inverse ETFs. So as the stock market falls, we buy an inverse ETF that goes up in value the same amount that the stock market falls. So we can profit from falling prices, but it's got to be a bloodbath. The markets have to be in a clear downtrend, and that's the only time we'll bet kind of, with a falling market.
So when you look at what I'm hearing you say, how would you define a diversified portfolio as far as an equity market goes, based on your strategy, your thought process? What's diversified for you? Because we hear that term all the time. You got to diversify,
Right.
but what does it mean?
Yeah. So there's a couple ways we could look at it. This won't cater to passive investors, but diversification between trading would be, you've got a very short-term trade strategy that you're firing off trades every week. You've got one that has trades every couple of months, and then you've got longer-term trends. So you're diversifying over different time frames, and so that's one way. But when it comes to diversifying in equities, either we're in them or we're not. And I just buy the SP 500 or the NASDAQ index. That is it.
Yeah.
I don't get into individual stocks or anything like that. So we're in or we're out. To me, diversification is owning different assets that are kind of not so related, like stocks, and then moving over to real estate, and then moving over to like whole life insurance. There's all kinds of different ways that you can invest and kind of spread your money out and protect yourself. That to me is diversification. Buying physical precious metals for inflation and for kind of like an insurance policy in case of currencies go down and things like that. So to me, diversification is a spread out across outside of the stock market. Get outside of that into different assets.
Well, I think it's, I know that Jim Rickards aligns with that because it used to be diversification was he owned, 30 different stocks in different sectors, and that was called diversification. Now it's diversification. To your point, is it's some equities, it's some real estate, it's some precious metals, it's some Bitcoin perhaps. And that's more of a diversification given what we don't know in the world is where things are going, and you're hedging your bet, you're playing defense along the way. So all those are, I guess, part of the game that has changed and experts like yourself are looking at and stepping back from. And I mean, you yourself, you talked about the real estate you owned, and that's part, I guess, of a diversified portfolio is getting outside of any one sector and looking at where things could go. Are you along the same thought process? Is that ultimately sitting in cash these days? I get it that, you want to get into cash when the time is right and out of cash when the time is right. But sitting on the sidelines and there's a degree of liquidity that you have to have. But if somebody's listening to this and they're going, okay, I got 100 grand or 50 grand or whatever the number is, I don't know what to do with it. What kind of, I guess, guidance or what perspective would you give them to say, well, here's how to look at that. There is opportunities here and here. And I don't know, maybe you can't speak to that, but just the thought process around it, Chris.
Yeah, I mean, I mean, to me, the real goal is to always go for passive income, and
Right.
real estate is such a no-brainer. The problem is most people they're not in it for the long game. People just are impatient. They sell homes on average like every 5 years.
Yeah.
I mean, um, and the stock market, if you're really young, if you're in your 20s or early 30s, yeah, you could just dump it in and leave it. I think there's way better ways to do it. But if you had a certain amount of money, I do feel like we're going to see a reevaluation event across assets. I've been liquidating, and I got a lot of cash reserves because I think we're going to see a good opportunity in real estate in the next few years. I think things are going to soften up, and I'm watching the markets very closely with one of my friends and a young kid who's only 14. He's interested in real estate, but we're going through it. We go through every duplex and triplex in our town. And we talk about it's on the wrong side of the tracks. It's lipstick on a pig. It's a century home. Everything for sale right now is the worst home. I would never buy them. And they're selling at unbelievable pricing, and they're in terrible locations. And I feel as though we're in like this bubble phase for real estate. It might take a while. Real estate is a slow moving beast. It happens typically after the stock market and the economy starts to go weak. It's very slow, but I do think there's going to be a great opportunity. And I don't think now is the time to just dump it into like an equities play. I think holding on to it until there's a really good investment, because I don't think there's a lot of good investments out there. And I'm almost nervous with the banking system, as a bank could go under and take your money with it. Banks are only insured for 100K in Canada, a bank account. So it's not very much. So I mean, I would look for with that money. The key is to buy into a new bull market when one starts. And I don't think we're near one at this point. That's when I think you can dump it in and wait a long term, or wait for the real estate to come around to pick up a multifamily property.